Hello friends, my name is Dr.Sunjeev Batra. I have been retired from the Income Tax Department. At the time of retirement, I was working as an income tax officer. This is my third class on the topic of penalty and prosecution. We have already taken two classes on the provisions of penalty and prosecution. In the last two classes, I have told you about the main section, that is 270 capital A, wherein the penalty for underreporting, misreporting of income provisions are stipulated. Now in this class we are going to start further, but before continuing this class, I would like to recap what we have taught in my last two classes. In the last two classes we have covered up to subsection 5. One by one we will take up subsection 1 to 5 again, so that you can have the knowledge of the subsections where the provisions are stipulated regarding the penalty under section 270 capital A. First subsection is 270 capital E. In subsection 1, I have told you that who can impose the penalty, who are the authorities whom the Act mandates the penalty can be imposed under this section. There are three authorities. One is assessing officer, second one is Joint Commission Appeal and the Commissioner of Income Tax Appeal, and the third is Commissioner of Income Tax or Principal Commissioner of Income Tax. They can impose the penalty while completing the proceedings under the Act. In subsection 2, I have told you about the person who is having the underreporting of income. There are 6 clauses in that. In nutshell, I would like to tell you about who is the person having the underreporting of income. If the person has filed the return of income, in case the person has filed the return of income, in that case, income assessed and the income determined under section 143(1)(a), the difference between these two income, it means that when the income assessed is greater than the income determined under section 143(1)(a), the whatever is the difference amount, that will be the underreporting of income. In the second clause, we have discussed about when the assessee has not filed the return of income or filed the return of income in response to notice under section 148. Now the question arises, what will be the underreporting of income in that case? The difference between the income assessed and the maximum amount not chargeable to tax shall be the underreporting of income for that person. In the next clause, I have told you about when the income is reassessed. In that case, the difference between the reassessed income and the last assessed income or the last reassessed income shall be the underreporting of income for that person. Besides it, in the next clauses, I have told you about the deemed total income assessed. Provisions are same, only the deemed total income under section 115JB or 115JC has been mentioned. When the income is assessed under that section, then the difference between the income assessed and the income determined under section 143(1)(a), if the return of income has been filed, or difference between the assessed income or the maximum not chargeable tax shall be the underreporting of income, and the difference between the reassessed deemed income and the deemed assessed or reassessed income shall be the underreporting of income for that person. Besides it, if the income assessed or reassessed has the effect of reducing the loss or converting such loss into income shall be the underreporting of income for that person. So you have understood about the provisions of subsection 2 also. In the third subsection, I have told you about what is the underreporting of income. Again, whenever assessee has filed the return of income for the first time, in that case, difference between the income assessed and the maximum not chargeable tax shall be the underreporting of income. In case the return of income has been filed, the difference between the assessed income and the income determined under section 143(1)(a) shall be the underreporting of income. Besides this, the formula, I have also discussed about the formula, wherein the formula was A minus B plus C minus D. A was the income assessed as per the normal provision. B was the income assessed as per the normal provision in A. B was the income assessed as per the normal provision minus underreporting of income. The difference between these two shall be the underreporting of income, plus C is the deemed assessed income. D means deemed assessed income reduced by underreporting of income. What will be the difference between these two? C minus D shall be the underreporting of income. When all the underreporting of income from both view, normal view or the deemed total income view, is calculated, computed, then we will aggregate both amounts and the underreporting of income for that person. In the fourth subsection, I have told you, whenever we find any receipt, deposit or investment appears in the current year, but the source of these underreporting of income pertains to earlier years, preceding years. In that case, and when source of income have been added in the early assessment year, but no penalty was levied. In that case, underreporting shall cover that amount for levying of penalty. In the subsection 5, I have told you about in what order the sources have been taken for imposing the penalty under section 270 capital A. So, in last two classes, we have covered till subsection 5. Now, we are going to take subsection 6 in this class. Subsection 6 tells us about or stipulates that when the income shall not be treated as underreporting of income. What are the circumstances? What are the facts when the income shall not be treated as underreporting of income? There are 5 classes in this regard. We will take one by one. In the first class, if the amount of income in respect of which assessee offers an explanation and authorities consider is bona fide, in that case, that amount of income shall not be treated as underreporting of income. In second clause, next clause, if the amount of income determined is on the basis of estimate and books of accounts are complete and to the satisfaction of the authorities, in that case also the amount of income shall not be treated as underreporting of income. In the next class, if the amount of income has been added suo motu by the assessee and it is on the lower side according to the assessing officer. In that case, assessing officer makes the addition on the higher side. Let us assume if the assessee suo motu adding the expenditure under the head telephone on account of personal consumption, let us assume that 1/5 has been added. But according to the opinion of assessing officer, it should be 1/4. In that case, the difference between these two shall not be treated as underreporting of income. Now come to the next class. It tells us about when the amount of income or the addition made in conformity with the arm length price determined by the TPO, means transfer pricing officer, and the assessee has maintained the information and documents under section 92D declared under the international transaction under chapter 10, then that amount shall not be treated as underreporting of income. And the last class is about the amount of undisclosed income referred to in section 271 AA-B. This amount, the undisclosed amount, is determined at the time of search and seizure cases. So, what we have learnt in the subsection 6? In subsection 6, we have learnt when the amount of income which is added shall not be treated as underreporting of income. Now come to the subsection 7 and 8. This stipulates that whenever, at what rate the penalty for underreporting and penalty for misreporting shall be calculated. In subsection 7 tells us about that penalty shall be calculated at the rate of 50% of tax whenever there is a underreporting of income. Subsection 8 tells us about whenever there is a misreporting of income, the penalty shall be calculated at the rate of 200%. Now come to the subsection 9. Subsection 9 is quite important because it tells us what type of income shall be treated as misreporting of income. Misreporting, it is the income which is in consequences of underreporting of income. So there are 5 clauses under this subsection. First section tells us about misrepresentation or suppression of facts. You can assume that you can see my slide also. I am taking you to the slide 22. In this case, I have mentioned what are the circumstances where the misrepresentation or suppression of facts shall be the misreporting of income for that assessee. Let us assume that he is not offering the rent in the return of income. In that case, assessee will be treated as suppress the facts so that amount shall come under this category and shall be treated as misreporting of income. Rent is not disclosed by the assessee, or false claim of deduction under chapter 6A, for example 80C. So it is treated as misrepresentation or suppression of facts. Next clause is about when the assessee failed to record investment in books of accounts. What is the example for that? Let us assume that investment made in jewelry but not disclosed in the ITR. In that case, that amount shall be treated as misreporting of income. The third clause is about claim of expenditure not substantiated by any evidence. Let us assume that there is a case of bogus interest claimed under section 24B. Under section 24B, we claim the interest on borrowed capital, and that amount is reduced under section 24B under the head of income from house property, and the deduction is allowed up to 2 lakhs. So whenever the assessee making the false claim under this subsection, under this section, in that case, that amount shall be treated as misreporting of income. The next clause is about recording of any false entry in the books of accounts. It means that when, let us take an example for that, goods not received, but the only merely invoice has been issued by the assessee. In that case, that will be treated as misreporting of income. In the next clause, failure to record any receipts in the books of accounts. Whenever there is a case of unaccounted sales which has bearing on total income, that shall be treated as underreporting of income. Failure to record any international transaction or specific domestic transaction not reflected in audit report 3C EB. In that case, that amount shall be treated as underreporting of income. In the next slide, I have given you the example. We will discuss this example. In this example, Mr. X is a person who is having the age of 61 years, does not furnish his return of income for the assessment year 2019-20. The assessing officer complete assessment under section 144 of the Act. Income assessed by the assessing officer is rupees 1 crore 14 lakhs. It includes rupees 40 lakhs being misreporting income on account of misrepresentation or suppression of facts. Income of rupees 1 crore 14 lakhs includes short-term capital gain also of rupees 18 lakh on transfer shares in the National Stock Exchange. Determine the amount of penalty under section 270 capital. First, now come to the solution. Income as per section 144 is 1 crore 14 lakhs, less exemption limit because it is a case of individual who is a senior citizen. So we have reduced the maximum not chargeable to tax, that is rupees 3 lakhs. Now underreporting income in this case is 1 crore 18 lakhs. But this amount includes 40 lakhs for misreporting of income. So how the tax shall be calculated for this? Now you can see in this case return is not furnished and income is assessed first time. Underreporting income 1 crore 11 lakhs after deducting maximum not chargeable tax. At, as I have told you in the earlier examples also, while discussing the subsection 3, add exemption limit 3 lakhs, total is again 1 crore 14 lakhs, tax shall be calculated on 1 crore 14 lakhs, that comes to rupees income tax. First we will calculate income tax 15% of rupees 18 lakhs and normal tax on balance of rupees 96 lakhs because 18 lakhs is the short-term capital gain and the rate of tax for the short-term capital gain is 18 lakhs or 15%. So the total amount of tax comes to rupees 29 lakhs 60,000. We will add surcharge, we will add HEC. After that, the total tax on underreported income comes to rupees 35 lakhs 40,160. Now, in this slide, I have segregated the underreporting of income tax on underreporting and misreporting of income. Underreporting income is 71 lakhs, misreporting is 40 lakhs, and total is 1 crore 11 lakhs. Tax on underreporting income shall be 71 divided by 111 into total tax 35 lakhs 40,160. Then the amount comes to rupees 22 lakhs 64,427. And the balance amount is tax on misreported income, and the method is 40 divided by 111 into 35 40 160. And the total amount of and the penalty and the amount of penalty comes to rupees at the rate of 50% and 200%. At the rate of 50% for underreporting of income is 11 lakhs 32,214. Misreporting of income penalty shall be 200%, and the amount comes to rupees 25 lakhs 51,466. And the total amount of penalty comes to rupees 36 lakhs 83,680. So in this subsection we have learned the cases where the income shall be treated as misreported income. And now come to the subsection 10. Subsection 10 tells us about how the tax shall be determined in the case of underreported of income. We have already discussed in the illustration, but again we will take up this provision. Under this subsection, when the assessee has not filed the return of income or filed the return of income in response to notice under section 148, that is the first time, and the income has been assessed first time, in that case amount of tax calculated on the underreported income as increased by the maximum amount not chargeable to tax. We have taken different example for this in my previous classes. Now come to the circumstances where the assessee has filed the return of income. Where the income of the assessee has been determined under section 143(1)(a). In that case, whatever will be the underreporting of income shall be increased by the income determined under section 143(1)(a). On that amount, tax shall be calculated, reduced by the amount determined under section 143(1)(a) shall be the tax on the underreporting of income. It gives us this subsection also gives us a formula. Formula is x minus y, where the x is treated as amount of tax calculated on the underreporting of income as increased by the income determined under section 143(1)(a, or total income assessed or reassessed or recomputed in preceding quarter. Y is the amount of tax determined under section 143(1)(a or total income assessed, reassessed or recomputed in preceding quarter. Now come to the subsection 11. It tells us that no additional disallowances of an amount shall form the basis of imposition of penalty if that amount has already taken into consideration for levying of penalty for the same or any other assessment year in the case of same person. Subsection tells that the penalty shall be imposed by the authorities in writing. So we have covered in this class all the subsections under section 270 capital A. Before closing this class, I would like to mention also when the assessee may be granted immunity from imposition of penalty and prosecution. That is defined under section, that is stipulated under section 270 capital A. You can see also in my screen. In the case, assessee is having the underreporting of income, not misreporting of income, and he has filed the application within 1 month from the end of the month in which the order is received. He has to apply in form number 68 for the immunity from the penalty and prosecution, and in that case he has to deposit the tax within the date specified in the demand notice. Let us assume that the demand is rupees 1 lakh and he has to deposit that amount within 30 days. So on or before the 30 days, he has to deposit that amount with interest. After that, he can apply for the immunity from the penalty, but only in the cases of where the underreporting of income, and he will also get the immunity from the prosecution under section 276C or 276CC. 276C stipulates about willful attempt to evade the taxes. 276CC stipulates about the where the assessee has not filed the return of income. So he will not only get the immunity from the penalty but also will get the immunity from the prosecution also. But there is one more condition: he should not file the appeal for the same. In that case only he will be granted immunity. Immunity will be granted by the AO within 1 month from the date of filing of application by the assessee. From the date of filing application from the assessee, immunity can be granted by the AO, or even if he wanted to reject the application, the order has to be passed within that period. So all the conditions are to be satisfied for granting the immunity by the authorities. All the conditions are to be satisfied by the assessee, so that AO shall be able to grant the immunity to the assessee from penalty and prosecution. Now I end this session. And thank you, and I request you to, if you like my class, kindly like it, share it, subscribe it. It will motivate me for taking further classes. There are so many classes. I have also received the feedback from listeners, and one by one we will take up that topic also. First, I will complete all the penalty provisions. After that, we will take up another topic under the Income Tax Act. Now, thank you again, and we will meet in my next class. Thank you.